Let's walk through a real example of how the FIX protocol works in equity trading. Imagine a portfolio manager wants to buy 50,000 shares of Microsoft. Step 1. The order management system sends a fixed message called a new order signal to the broker. The message includes details like the symbol MSFT, the side which is buy, the quantity of 50,000 shares, the order type which is limit, and the price of $350. Step 2. The broker receives the order and sends back an execution report to acknowledge it. This report confirms that the order is live and working in the market. Step 3. As the order starts to get filled on different exchanges, the broker sends partial fill execution reports back to the portfolio manager. For example, the first report might say that 20,000 shares were filled at a price of $349.75, with 30,000 shares still remaining. Step 4. Finally, once all the shares have been bought, the broker sends a final execution report showing that the full 50,000 shares have been completed at an average price of about $349.80. Step 5. To finish the process, a trade capture report can be sent to the client's systems. This report provides the final booking details of the trade, which is used for record keeping and settlement. This entire process happens in real time using the FIX protocol. Every step, from the new order to the partial fills to the final booking, is communicated in a standardized language that both sides understand. That's why FIX is called the backbone of electronic trading. It connects traders, brokers, and exchanges in one common language. If you found this explanation helpful, please like the video and subscribe to the channel for more simple breakdowns of trading and finance.